The members of the panel are Claudia Buch, Deutsche Bundesbank, Michael Heise, Allianz, Pieter Krahnen, Frankfurt University, Fabrizio Saccomanni, International Affairs Institute, Italy, Ludger Schuknecht, German Ministry of Finance. This panel is moderated by journalist Kevin O'Brien.
Okay, great. Let's get right into it then. First question goes to Mr. Heise, the chief economist of Allianz. Mr. Heise, you'll talk about the role of the long-term investor in financial market reform, but I wanted to ask you up front, 10 years after the global financial crisis, is Allianz too big to fail?
Well, that's a nice specific question. Well, the bodies that make these decisions, who is too big to fail, have decided we are too big to fail. But this is for different reasons than when banks are too big to fail. We don't borrow money on markets, but we have huge investments, of course, also in the asset management, but also as an insurance industry. And if we were to get into some kind of trouble, there would be heavy sales, of course, of securities in many different countries. The capital markets would be affected by that, and that would exacerbate other problems that will be there in a situation of turmoil. So yes, we are a global, systemically important institution.
If I can just quick follow-up, do you like being too big to fail, or would you rather be under the radar?
Well, I think first, there was some reluctance to enter this process on our side because it is a lot of administrative work you have to do. There's an own department that makes reports only to show what we would do in times of a crisis. So first there was reluctance, but in the meantime, it is also seen as an advantage, and you can see it on the markets. The market shares are growing in very many countries of this world because the nimbus of safety, of security, of being watched, especially carefully by the regulators, is actually an advantage. So we can leverage that.
Some benefits to being under the microscope then. Ms. Buch, you wanted to talk about efficient regulation. Regulation. But let me ask you, you're the key Bundesbank representative on global bodies, G7, G20, ECB, etc. What is the political environment right now globally in terms of managing the world financial system? It seems like we're in a period of backlash to the post-2007 reforms, and at least, for example, in the United States, there's rhetoric of rolling some of those back. So how do you see that?
Well, it would be difficult for me to comment on what's going on in the US, but so let me talk about what we do in the G20 and also in the FSB, the Financial Stability Board. And I think it's always the case once you've done reforms, at some point in time you tend to forget why you did these reforms. So remembering the crisis, the effects of the crisis, this is something which is fading a bit, and I think it's always important to make us aware that actually the effects or the legacies of the crisis are still with us. So we still have very high debt levels, so talking about resilience, that's an issue. We also have increasing evidence coming in that the real effects of the crisis start to become visible. We have long-term growth, which is below the trend we've seen before the crisis, which may not be the right benchmark, but we see that the distortions in the financial system are still there and also affect resource allocation. So I think it's important always to remind us that resilience obviously is still a very important issue. That's why it's also, Ludger can say more about it, a key topic under our German G20 presidency. Now, what the FSB is doing, what our international coordination and cooperation is doing is to say, well, we've initiated a lot of reforms, ending too big to fail is one of them, also increasing capital in the system, transforming shadow banking into market-based finance. So we've started a lot of reforms. Most of them are well underway in terms of implementation. And now it's also the time starts to take stock of what we have done to evaluate the effects of reforms. And this is partly what people say, well, we've had all these unintended consequences of reforms. I think it's also important for us to understand the intended consequences. And it's pretty clear that this has to be part of a structured process. So we have to have a good process in place which leads us to evaluate reforms, and then maybe, if need be, to also change some of the reforms or address new risks that are emerging, but we can't do this ad hoc. We need a structured process for that.
So the patient is not fully healthy? It's still under observation? You haven't let him out of the hospital yet?
It's an evolving system.
Okay. Mr. Krahnen, you've been involved in 2 government efforts to improve the global financial system, both here in Germany, the Ising Commission, and an EU attempt in 2012. Can you talk in general about these types of attempts to improve the free market, so to speak? How much is promise, and what comes out at the end?
I think one of the great successes of these efforts, I'm now talking about these commissions, but also more generally what has been achieved here on the G20 level, is that there is a common understanding of the objective, the goal. What are we trying to achieve? And you said the word market power, so I think market discipline, bringing this back to the banking sector, is also theoretically a very difficult problem because of the risks that Franklin Allen was pointing at. We have systemic risk, a particular feature only of the financial industry. Now, how can we bring in market forces to achieve some efficiency in the sector itself? And we have the rules, we have the ideas, but we have not fully implemented. So if I have to summarize my current assessment, I would say what the way the direction is well taken, is well founded, but most of what we have on the level of hindering too big to fail to happen is not yet credible. And establishing credibility is the thing that has to be addressed very soon, and there are clear statements in what direction that goes.
Thank you for that. Mr. Saccomanni, you've heard some comments about how it's possible here through intelligent regulation to solve all of our problems. Is it that easy?
Well, thank you. I have led a sort of a task force within the T20 exercise, and we have prepared a paper which is available on the G20 Insight, which states, the title is Beyond the Financial Regulation, the Need for a Broader and More Coordinated Capital Flow Management Strategy. So, I think, regulation is necessary, is good. Probably it needs to be stabilized, because I think there is a little bit of regulatory uncertainty and regulatory fatigue in the world. But I think it's good, and I personally worried about the prospect of the United States undoing the Dodd-Frank, if I can be explicit as a former minister. Now I can say what I think. But the point about the sort of a coordinated strategy of capital flow, I think, comes from the work that has been done, again, under the aegis of the G20 by institutions like the IMF, the BIS, the OECD. And I think there is a sort of an emerging consensus that you need a little more than just regulation to sort of orient capital flows towards stability, monetary stability, and financial stability. Because, capital flows are good because they finance investment, infrastructure, and so forth, but they can also create a lot of volatility, and they can create a situation of tensions when they come in, because they may create some sort of excessive credit creation, and they create problems when they go out, which sometimes happens suddenly with little sort of advance notice. So I think the G20 probably needs to be taking the lead on this issue, to give sort of political support to this type of research that is being conducted, and perhaps I can argue a little more about how we can do it.
You'll have an opportunity to do that, I promise. But then let me turn to Mr. Schuknecht, sitting right next to you. regulation, despite your best efforts, is not enough. There needs to be some type of new management of the global financial system. From the German perspective, is that something you would welcome? Germany's always been calling for better state finances and balanced budgets, etc. Is this some kind of a global financial, not a control, but management? Is that something you'd like to see?
Well, I mean, financial resilience comprises several elements. As Claudia was saying, the German presidency emphasizes, of course, the role of financial regulation, of completing the regulatory agenda, of doing the evaluation. And there are some important elements which are still being completed during our presidency, on which I could comment later. But referring to your question, a second very important element of financial resilience is also healthy state finances. And that's, for obvious reasons, a government that is in trouble, that cannot finance its obligations, it doesn't do good services to its people, it does not provide safe assets for investors, it cannot provide a kind of a backstop in case there are banks or in case the financial system gets into difficulty, and and if you have weak public finances, then you are less likely to survive a financial crisis without major damage also to your real economy. So I think that sound government finances are an important or key element, a prerequisite almost of financial resilience and of making all our efforts in the financial sector credible.
Thank you. Mr. Franklin, you live in London now, but you spent 30 years or more living in the States. What is your assessment, and you just recently moved back to London, do you believe the United States under President Trump will attempt to roll back a lot of the post-2007 reforms, or is that rhetoric?
So I think it's very difficult to understand exactly how much he will do of what he says, but I think there is a good chance that he will roll back some of the financial regulations that's put in place since then. Certain parts of the Dodd-Frank, like the Volcker rule and so forth, watering down of capital regulation and so forth, I think is quite likely.
And if I can follow up, what effect, if any, would that have on world financial markets, beyond cosmetic?
So the problem is we'll be back to where we were to a large extent, at least in the US, prior to 2007, and that's not a good place to be given what happened with the financial crisis. So I think we have made progress, but that may well be rolled back if we have a lot of deregulation in the financial area in the US.
Wow, that sounds like Back to the Future then,
Yes.
to a bad future. If I can turn to Mr. Heise again and ask you from the perspective of the insurance industry. We're talking here about improving the functioning of the global financial market through perhaps regulation or other measures. Insurers, your industry is having a difficult time with the zero rate environment, which has disrupted your investment model. The global system may have to change. Doesn't the insurance industry have to change the way it does business?
I think quite a lot has to change. Behind that question, I would see that as a backdrop, the growth of debt, which you alluded to, is reappearing in the United States already, going fast. It has to do with low interest rates, but it's not only taking place in industrialized countries, it's also taking place in the emerging market world, which we are all together here. And so, for the G20, I think this would be a very important message to keep under control the accumulation of debt, which is going very, very fast in many emerging countries. And I just hope that many emerging markets don't repeat the errors that were done in the industrialized countries, letting this debt machine get out of control with all the subprime, short-term debt behind it, which had devastating impact. So this is a very general point before I address the insurance industry, which also has to change and which has changed. Actually, in Germany, there has been something like a silent revolution, I would say, not really noticed by the general public, that the products that the life insurers are actually supplying to the market are completely different from those maybe 2 years ago. They are thankfully in high demand, although their return is very low due to the low interest rate environment, but there are no good alternatives. A bank account gives you a negative real interest rate, and all alternatives and stock prices are high, and real estate is moving up, so there's still quite a lot of demand for life insurance. But of course, our investment has changed very much.
Ms. Buch, how optimistic are you that out of the G20 will come concrete measures to improve the stability of the international system? Are you confident or are you skeptical?
No, I'm confident. I mean, if you look at what I said before, what has been done, what has been decided in terms of reforms in the FSB, in the standard setting bodies, I mean, there's been a major effort after the crisis, and I think the task we have now, again, is to look at the effects of these reforms, do it in a coordinated way. I think there are many spillovers cross-border that others have alluded to in terms of capital flows to emerging markets that may be volatile, where the regulation has an impact. And I don't think we can look at the effects of these reforms in isolation. We have to do it collectively, internationally. We have to decide, how do we want to do this? How do we want to also join forces internationally to perhaps, if need be, modify reforms. So I mean, there's no way that we can deal with all these issues at a national level, and that is very well understood. So we got actually big support for this agenda to do a more structured evaluation of policy. So it has been endorsed. There's been a public consultation where we got a lot of feedback from industry and from academia. And so this framework for the evaluation of reforms will become effective. For now, it's just a framework that is very high level, so it has to be filled with life, so to say. We have to actually implement it, but there's a strong endorsement for these efforts at the international level.
Thank you. Cooperation at the international level sounds good, Mr. Saccomanni, but often very difficult to obtain. Are there limits to political pledges of good behavior? I mean, for example, I think the EU has set debt deficit criteria, medium-term objectives, so to speak, for all of the member countries. Those have been set in stone for quite a while. Currently, I believe only 6 of 28 EU countries meet those objectives for debt and deficit. Is it possible through coordinated, well-meaning government effort to improve the situation?
Well, I think the institutional framework that has been established in the European Union certainly provides, the basis and the instruments for correcting those imbalances. I think you have to understand that in a situation of slow growth, risk of deflation, and very protracted stagnation of the economy, the debt consolidation, the debt reduction has been more difficult in all countries, and also for the public sector and the private sector. At the same time, I think if you refer to my own country, I think Italy has tried to be in compliance with the deficit to GDP ratio. Since 2013, we have been out of the excessive deficit procedure. We're still not in compliance with the debt to GDP ratio, which has stabilized at a very high level, and we hope it will be reduced as economic recovery takes hold. But certainly what is needed probably is at the European level a more coordinated effort to revive economic activity, particularly focusing on investment, which has been lagging behind all over Europe, and I think this could certainly play an important role. At the same time, I think compliance with the rules is certainly necessary.
Mr. Krahnen, is it possible through political goodwill to achieve the improvements that are being desired here? You were a part of 2 efforts to improve the system. Were all of your recommendations embraced and put in place? Or?
No. Not, maybe not yet, but unfortunately not. I want to make one point
Please.
on this. We think this new regulation is in place and efforts are underway to evaluate this, but I would a little bit caution with respect to the degree to which this implementation has really happened. And we all feel, in a way, and know that Europe would need significant restructuring of its banking sector in several countries. That is, in a way, shared wisdom, but it doesn't happen anywhere. And that's, for me, a clear sign that the type of market discipline that we would like to inject into the system is not there. We have some of the walls of the new edifice in place, but there's no roof, there's no door, so there are certain very elementary things which can be done, which need the goodwill, but which are not being done. And so it's a bit early to take stock and say, well, where are we? Oh, maybe it didn't work. We should try something else. We should be serious on really fulfilling the last mile is in every marathon, which really counts, and here's the same thing.
Thanks, Mr. Krahnen. Lack of market discipline that's being desired, Mr. Allen. Everybody knows what needs to be done, but it's not being done. Why is that, do you think?
I think it's political forces. So in many of the countries where it's needed, there's a reluctance to admit to the problems, and that's a very strong current. So in countries like Italy and in Germany itself, there are resistance to admit that there are problems and that the capital that should be in place in terms of market value, it just isn't there, and it needs to be put in place. And I think we need more technical recommendations to overcome the political resistance, because it's a very important thing if we're going to avoid another crisis, to get debt levels down and get capital levels up in the banks.
Mr. Schuknecht, there is this fundamental difference in the approach to the financial markets. You could call it continental, Anglo-Saxon, etc. Throw more money at the problem or save your way out of the problem. Germany has always taken it's good to have the kitchen budget in order first, and everything stems from that. Do you think are we moving closer to a consensus globally, or is there still this divide over how to improve things, remedy things, respond to crises? What do you think?
Well, I would say there's a certain disconnect or a certain schizophrenia, because on the one hand, I mean, everybody argues that we need to have good financial regulation and that it needs to be implemented, and that should lead also to the resolution of banks that are not viable and bail-in and all that. But when it comes to public finances, to the public sector, many people are still arguing, that it doesn't seem to matter. And it's not clear, I mean, people say, okay, we should at some point start reducing the debt, but not now because the economy is too fragile and so on. So I think there is clearly a need for consistency in policies. I mean, we need to implement the rules we have both in the financial area and in the fiscal area. And in certain instances, like we have seen, this will mean throwing money at the problem in the short run, because, we need to have government programs, we need to have financial sector programs, because you cannot let the system completely unravel. But you must not move the day of going back to sound policies to never day. And I'm afraid that in Europe, I mean, as Mr. Saccomanni was saying, rules need to be implemented, fiscal rules, but we are not really doing it. And now we are in the process, or we are at risk of not implementing the banking union rules regarding some banks either. So that will not build confidence, and that will not build financial resilience. So what you're saying is not contradictory, but what I think our approach is that we are saying that in this environment, growth is reasonable. Italy is weak still, but on the whole, growth is good. And if we don't move to, going back to implementing the rules in both areas now, when?
Okay, thank you. At this point, I want to say to the audience that we'd like to take 2 questions. If you have them, please just raise your hand. I'll take one from a man, one from a woman. And we restrict you to a minute, so I'm sorry. Sir, Mr. Moledin will now make a comment or ask a question.
Just a question, what we should be expecting from the proposed revisions to Basel III, what's so-called Basel IV? What could we expect some more unintended consequences, and what can we be done about that?
Thank you very much. Does anybody want to take a stab at that one? Basel III, Basel IV? What do you folks have a big stake in it, so what do you think?
Well, yeah, we watch it closely as an insurer, not directly, but it alludes to one point that was made, that there's harsh competition, and it's not only political unwillingness to do, reforms, it's also an issue of competition. And if you put higher capital requirements on your banks, or if you don't accept the internal models with Basel III and say, now we need a leverage ratio, as the United States is saying, then this is an immensely important impact on the competitive situation of your banks. And this, of course, slows things down. And it comes back to what you said is one of the results of this great working group, that there should not be a race to the bottom, or framed differently, that we should have really a level playing field. This is so important that not regulation is used as a measure of attracting business. Yeah. And I think we missed the chance there, actually. The first G20 back in Washington was saying exactly this. We have to harmonize and go together. And in the meantime, because of the crisis and so on, we've seen things go apart again. I think a big chance missed.
So basic disagreement over the appropriate tools to get ourselves out of this situation. Mr. Saccomanni, if I can, simple question, or perhaps not. Is the global financial system today more resilient than it was before 2007?
I don't think so. And
so it's worse. It's worse. It's worse. Or
no, it's not worse, but it's not significantly better. I think I read with great interest a conference last October by Tim Geithner, the former Treasury Secretary, and he asked the question, "Are we safer?" And he concluded in the negative, and I agree with it. Because in my view, the strengthening of regulation on banks and financial institutions is not enough. And as I said, in the G20, we have followed a different type of policy approach. The advanced countries rely on free capital movements, floating exchange rates, and transparency and regulation. But the rest of the world, which is much bigger or getting bigger, they intervene in the foreign exchange market, they introduce capital controls, they accumulate huge amounts of foreign exchange reserves to fight the risk of capital flows and inflows, as I mentioned earlier. So I think we need to reconcile these two views, and I think the work that has been done in the G20 sort of points in the direction. We need to look at the financial cycle in the world economy, which is much more important than the sort of the business cycle in many ways, because it can have a lot of financial repercussions. So I think we need perhaps to strengthen what is called the global safety net, but also we have to have policies within the individual countries that are looking at financial stability and not just looking at it from the domestic point of view, but also to think about the repercussions and the spillovers to other countries.
Thank you for that. I mean, Ms. Buch, Chancellor Merkel yesterday, after returning from Italy, urged Europeans to take hold of their own destiny. In this kind of a matter, a global financial system, is it possible to determine your own destiny in a system where other countries have totally different ideas about what to be done?
Well, I think the statement yesterday was also related to much broader policy questions than the ones we are talking about here at the table. So I don't want to comment on that. So like I said before, I think it's the dealing with issues related to financial stability, the stability of the global financial system. This is not something we can do in isolation. I mean, maybe it's important also to note for this audience that if you look at how responsibility for financial stability is organized in Europe, it's basically a national task. So we have the German Financial Stability Council, which is dealing with financial stability issues, but this is all closely coordinated at the European level. So there's also a European responsibility because we know there are spillovers, and we have the international fora, the FSB, the G20, in which we coordinate these issues. So again, you can't solve financial stability issues alone, but there are many national policies which are relevant for financial stability, so you can't delegate it all to the international level. Let me raise one quick point to what Jan said earlier about market dynamics and what are we done with the reform agenda. That's certainly not the case. I think what's important is that if we want to look at what we have done, we need a lot of independence in this process. So a lot of the discussions we had here is also about the political economy of reforms and what are the interests of the different stakeholders in this process. And I think we need to develop mechanisms of how we can bring the policy community and the research community together so that they can actually jointly work on these issues. While bringing in their own standards. And I think the important contribution that academia can bring into this debate is independence and taking a different look at the issues and challenging us. And I think that's why this is discussion also in the context of the T20 is important. We only talk about the G20.
That's true. Thank you for that. We're approaching the end of our time, so I'm going to have to wrap it up at some point. But Mr. Heise, if I can ask you, one of the recommendations from Mr. Allen was to remove regulatory inconsistencies. One dealt with a subordinated bank bond, and that your industry might be more inclined to purchase if there wasn't a regulatory conflict with another set of regulations. From your view as a major long-term investor, is it these little regulatory changes, do they have a big impact on your behavior, or would you like to see other types of reforms, like an end to the ECB's cheap money policy?
That's a nice question. No, they have a big impact, definitely, the regulatory mechanisms that we are subject to, and they restrict the freedom of investment very much so. Our share in our portfolio of bank bonds
would be automatically
especially subordinated bank bonds is going to be fairly small because they require high capital cover, and that makes them not really attractive anymore. So this is an important thing. Also, the whole regulation of capital requirements is pretty complicated for us. When the interest rate goes down, as it has, especially in our location in Germany, to zero, then your capital requirements go up, and you have to start buying very long-term assets to cover your liabilities, which grow. And for doing that, you often have to sell equity, which is, for an economist, not really something attractive. When the interest is at zero, you start buying long-term bonds. So this is a little bit a technical thing, but it has very, very high implications. And therefore, one thing I would argue is that a change in monetary policy, which is not formulated by the Deutsche Bundesbank, but by the ECB in Europe, would be very helpful for the whole system. I think there are inconsistencies. Monetary policy is just pushing banks as strong as it can and even punishing them if they don't hand out more debt. While on this other side, the regulator is rightly saying, well, you better get your risks down and maybe your debt and loans down, so you're better capitalized. So this is a big inconsistency. And my wish would be that monetary policy actually, turns the corner. I think we're on safe ground for that.
Thank you very much. Unfortunately, we're at the end of our time now. I wanted to thank all of our panelists and ask the audience for a big round of applause for our panel today.